Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world one filing at a time. Today we're diving into ASIAFIN Holdings Corp. And let me tell you, this report has some interesting twists and turns that might just surprise you. So, what is the big story here? Well, ASIAFIN Holdings Corp is showing us a company that is trying to navigate some challenges but also spotting some opportunities. We've got a mix of revenue growth but also some serious concerns about expenses and profitability. Let's break it down. Before we get to the juicy details, if you love getting straight answers from complex financial documents without all the fluff, make sure you hit that subscribe button. And hey, we've built a fantastic community over on our Discord server, linked in the description below, where you can discuss these filings and more. So join us there. Alright, let's jump into this quarterly report. It covers the period ending the 30th of September 2025. Right off the bat, we see the company is filing as a non-accelerated filer and a smaller reporting company, which gives us some context on the level of detail expected. Now let's head over to the balance sheet. This gives us a snapshot of the company's assets, liabilities, and equity. As of the 30th of September 2025, total assets stood at about $4 million. That is a little down from the end of 2024, which was just over $4.1 million. Looking at cash, it is down from about $1.3 million at the end of 2024 to around $795,000 by the end of September 2025. That is a notable decrease, and something we'll want to keep an eye on as we look at cash flow. Account receivables, which is money owed to the company by its customers, is up slightly to about $1.3 million from just under $1.2 million. This could mean they're selling more, but also that it is taking longer to collect payments or they are having more bad debts. On the flip side, liabilities are showing a decrease. Total liabilities are down to about $1.78 million from over $2 million at the close of 2024. Specifically, accrued liabilities and other payables have come down from about $1.15 million to $904,000. This reduction, in short, term obligations is generally a good sign for immediate financial health. Now, looking at the bottom line for the balance sheet, total shareholders' equity also saw an increase, moving from about $2.14 million at the end of 2024 to nearly $2.27 million by the end of September 2025. This is driven by various factors we'll see as we look at the income statement and statement of cash flows. Let's move on to the income statement, which tells us about the company's performance over a period. Here is where things get really interesting. For the 3 months ended the 30th of September 2025, revenue jumped to about $1.57 million, a significant increase from $1.03 million in the same period of 2024. That is a nice 52.7% boost in sales for the quarter. For the 9 months, revenue climbed to about $3.2 million from $2.09 million. A solid 53% increase year over year. This shows the company is definitely bringing in more business. However, the cost of generating that revenue also went up quite a bit. For the 3 months, it increased by 70%, hitting $839,000. For the 9 months, it soared by over 46% to $2.16 million. This means the cost to deliver their services is growing faster than their revenue in the last quarter, which squeezes the profit margins. The gross profit, which is revenue minus the cost of revenue, increased in dollar terms. For the 3 months, it went up to $737,000 from $538,000. And for the 9 months, it rose to over $1 million from $614,000. But the percentage of revenue that turns into gross profit actually decreased slightly in the last quarter, from 52.2% to 46.8%. This highlights that while they are selling more, it is costing them more to do so. Then we have selling, general, and administrative expenses. For the 3 months, these expenses increased slightly to $368,000 from $347,000. But for the 9 months, they jumped significantly by 42.1% to $1.37 million from $969,000 in the prior year. The report mentions this increase is due to salary expenses, as they hired more people and an increase in credit loss allowance because they are having trouble collecting money from debtors. This is a red flag. When costs like salaries and potential bad debts go up this much, it can really eat into profits. And the bottom line for the 3 months ended the 30th of September 2025, the company reported a net income of $380,000. This is a substantial jump from $184,000 in the same period of 2024. However, for the 9 months, the picture is different. They reported a net loss of $300,000 in the prior year. So, while the company is doing better in the latest quarter, over the longer 9-month period, they are still losing money. though at a slower rate than before. Now, let's look at the statement of shareholders' equity. This shows how the owner's stake in the company has changed. At the start of the year, the 31st of December 2024, the company had total shareholders' equity of a little over $2.14 million. We see a new issuance of shares in January of 2025, which brought in some new capital. By the 30th of September 2025, total shareholders' equity grew to about $2.26 million. This growth is a combination of the net income in the latest quarter offset by losses earlier in the year, and also the impact of foreign currency translation. The fact that equity is growing, even with losses over the 9 months, shows that the income in the most recent quarter was strong enough to overcome earlier losses, and the new share issuance helped too. The cash flow statement is crucial. It tells us where the company's cash is coming from and going to. For the 9 months ended the 30th of September 2025, the company used $411,000 in operating activities. This is worse than the $257,000 used in the same period of 2024. This confirms that despite the revenue growth, the company's core operations are not generating enough cash, and in fact are consuming cash. This is a significant concern for the company's sustainability. In investing activities, they used $39,000 for assets like computer systems and renovations in 2025, down from $104,000 in 2024. This suggests they are spending less on long-term assets, which could be a sign of belt tightening. Financing activities shows the company used $100,000 in 2025 compared to $55,000 in 2024. This is primarily due to advances to directors and related companies. This means they are taking money from financing sources like loans or equity and using it to fund operations and other activities, which is not ideal for a company trying to become profitable. Let's zoom into the details of the business. ASIAFIN Holdings Corp is a holding company that provides information technology services. They have a pretty diverse set of subsidiaries operating in different regions. They mention their subsidiaries like ASIAFIN Holdings Limited in Hong Kong, StarFin Holdings Limited in the British Virgin Islands, and several others in Malaysia, focusing on investment holding and its services. This structure suggests a strategy of regional diversification. The company operates in multiple countries, meaning currency fluctuations can impact their financials. For instance, the Malaysian ringgit to US dollar exchange rate has fluctuated, and this is something they have to manage. The period NMA to USD rate was 4.21 in 2025 compared to 4.13 in 2024. And the average rate was actually higher in 2025 than in 2024, meaning the USD was weaker against the MER in the average for the 9 months of 2025. Now, this is a critical section for understanding vulnerabilities. Let's look at customer concentration. For the 3 months ending the 30th of September 2025, 2 customers accounted for 23 to 14% of their revenue. This means a significant portion of their income comes from just a few clients. If even one of these major clients leaves, it could really hurt the company financially. For the 9 months, 1 customer made up 23% of revenue in 2025. This dependency on a few large customers is a significant risk. The tax section is always a bit dense, but here is the takeaway. The company operates in various tax jurisdictions like the US, Hong Kong, and Malaysia. Interestingly, they have significant deferred tax assets, mainly from net operating losses. However, they've also put a full valuation allowance against these assets, meaning they do not expect to realize these future tax benefits. This is because they are not currently profitable enough to offset these losses, and they believe it is unlikely these benefits will be realized. This reinforces the point about their current lack of profitability. Here is a section that really stands out and raises concerns about the company's internal operations. They explicitly state that their internal controls over financial reporting are not effective due to material weaknesses. These include a lack of a functioning audit committee, inadequate segregation of duties, insufficient written policies, and no internal audit function. This is a serious warning sign about the company's governance and operational integrity. It means there is a higher risk of errors or even fraud in their financial reporting. The report further details these weaknesses. They acknowledge that their internal controls might not prevent or detect all misstatements, and that their effectiveness can deteriorate. This lack of robust internal controls, especially for a publicly traded company, is a major point of caution for any potential investor. Overall analysis. So what is the big picture here? ASIAFIN Holdings Corp is clearly growing its revenue, which is a positive sign. They are bringing in more customers and increasing their sales. However, this growth is coming at a significant cost. Their expenses, particularly selling, general and administrative costs, are rising faster than expected. And they are struggling to collect payments from some customers. The fact that they are still reporting losses over a 9-month period despite revenue growth and are consuming cash in their operations is a major concern. The fact that they've put a full valuation allowance on their deferred tax assets speaks volumes about their current lack of profitability over the long term. What really caught my eye, however, are the material weaknesses in their internal controls and financial reporting. This isn't just a small hiccup. It is a fundamental issue that raises questions about the reliability of the numbers we're seeing and the company's ability to manage itself effectively. For investors, this points to a high-risk situation. While there is potential for growth, the operational and financial stability doesn't seem there yet. They have a good strategy in place with FinTech, RegTech, and RPA. But the execution and foundational controls seem to be lacking. This is a company that is still very much in a growth and development phase, battling to achieve profitability and strengthen its internal processes. It definitely requires very careful consideration before investing. Alright, that is our deep dive into ASIAFIN Holdings CORP's latest filing. What is your take on these numbers and what they signal for the company's future? Do you see the revenue growth as a sign of promise, or do the control weaknesses and cash burn outweigh that? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and of course subscribe for more in-depth looks at corporate filings. And make sure to join our growing community on Discord, the link is in the description. Thanks for watching, and we'll see you in the next video.